You can never be sure what'll happen, but I don't think first of all, I don't think we'll have a bear market like 2022. I think the only people that say that are the crypto bros, and the crypto bros are the ones that created the bear market of 2022. And they did it because they don't understand finance. And if I explain it in a nutshell, it's if you lever up yo-yo token 10 or 20 to 1 and in order to create a $10 billion FTT market cap. And then if you pledge $1 billion of yo-yo token and borrow Tether, and then you buy JoJo coin, and then if you lever that up 10 to 1, and then you take that and you buy Bitcoin with it, then at some point yo-yo token or JoJo coin collapses and you've got 100 to 1 leverage in the system. And by the way, and if you're silly enough to give someone $1 billion of loan, $1 billion loan with $800 million of JoJo coin or yo-yo token as collateral, like you're under collateralized to start, then you've just created this massive 100 to 1 leverage structure. And that's exactly what happened in 2022. Luna collapsed, FTT collapsed. You know, you had all of these players that were under collateralized lenders and 100 to 1 lever, and they all got wiped out and bankrupted. What I'm describing there, you literally cannot do in the traditional finance system. Go to your bank and offer them $1 billion of Bitcoin and then try to get a loan. Now offer them $1 billion of Bitcoin and try to get a $1.5 billion loan. They'll literally laugh at you, right? You'd be, like, are you kidding me? You cannot leverage. All the Bitcoin treasury companies, they're not levered, right? They're like 80% equity and 20% convert, and the convert is almost always hedged. When you sell $1 billion of convert, the convertible arbitrager sold $750 million of your equity. So there's only $250 million out of, $5 billion that's actually in any way levered. So we don't have the leverage in the system that we had then. You can't even get the leverage in the system. Because as long as you're using, and I'm combining my comments to Bitcoin and traditional finance. I'm not talking about other tokens and other token treasury companies, right? Like if you capitalize on a token that's got built-in leverage, then yeah, you could have a rug pull and it could collapse on you. But if you just look at the Bitcoin ecosystem right now, for the most part, it's equity capital, and if there's any leverage, it's like MSTR might be 10% levered. Right? However you call it. During the 2021 run-up, you had companies that were, I'm not describing 1.1 leverage, that's what we might be. They were a 100x leverage. So there's a difference between 1.2 and 50 or 100. So I don't think you see that kind of volatility. I don't think you see that kind of drawdown. But having said it, Bitcoin comes back a bit. The premiums, they will fluctuate. Is it possible to create a Bitcoin treasury company that trades at a discount to NAV? Sure. I mean, if the operating business has debt on it, if the operating business is burning cash, if people lose confidence in the management team, if a $500 million company has the CEO announce he's giving himself a $300 million pay package, right? There are ways to crush the equity, right? Be irresponsible with regard to the way you run the business. It crushes the equity and you trade at a discount. But if you have a well-run Bitcoin treasury company, say you have $1 billion of Bitcoin and your equity trades to $900 million in equity value. What do? The logical thing you do is you issue $100 million of BTC 10 rated credit, investment grade credit, like Strife, buy the stock back. Right? Then, issue $200, $300, $400 million worth of junk credit, like Stride, and buy the stock back. So you issue preferreds and then you buy the stock, or you issue something like Strike, issue a convertible preferred with a 200% premium built into it and buy the equity back, right? The equity investors will look at that and they'll think, well, there's massive volatility, massive leverage. Why wouldn't I want to buy that? It's like I'm buying the senior 20% of the capital structure and I'm creating a short squeeze. So the real key to protecting the equity premium in a Bitcoin treasury company is building these BTC-backed credit instruments and getting them floating in the preferred market and attaching an ATM to them. If you have, the reason to do what I've described is offensive, because if you have a good BTC credit program, the MNAV could trade to 3, 4, 5, 6, 10. Right? I mean, you could trade at a massive multiple. Like, by the way, I'm just describing price to book. If you look at how you value a bank, they're like, oh, that trades at 2 times book value. Well, MNAV of 2 is 2 times book value for the company, right? So if you have the credit instruments, you create leverage, the equity will trade up. So it's offensive, but it's also defensive. If the shorts jump on you, how do you rip the faces off of the shorts? You sell the credit instruments, and like, what would you hope? You would hope that they would short you to 50%, of net asset value. You would sell 200 million worth of a junior preferred or a senior preferred, buy the stock back, and you're monetizing the discount. You're actually generating BTC yield buying the stock. And then you create a short squeeze. And as soon as you start to squeeze the shorts on that side, all the equity investors will jump on it, and the options investors will jump on it, and they'll rip their faces off. So you don't really have to be in fear if you're a financial engineer. You have $100 billion of Bitcoin. You're either trading at a premium and you're selling the equity, or you're trading at a discount and you're selling the credit. Right? What shuts that down? If you can't sell the credit, right? If you've impaired, the reason that the company struggles is you've impaired the capital structure somehow by doing something stupid. But if you have unimpaired capital structure, if I have $100 billion of Bitcoin, I should in theory be able to sell 10, 20, 30, 40, $50 billion of credit at various rates, BTC 10, 5, 3, 2. When you do that, you either buy Bitcoin or you buy your own equity back, but you wouldn't have to buy that much equity back before. Like once you punch a bully in the face, like if the short seller gets to a certain level, once you slug them in the face, right, that they're not really in it for the pain. As far as I could see, there's really no intelligent investor who's a short seller. Like, for example, they don't have any courage. There's no one with $10 billion of capital saying, I'm willing to go short $10 billion and lose it all. Right? So, you got a fund, the guy dabbles in it, he's like, I got a short, but no one wants to ride that one to infinity. They just don't have the courage.
How do you see the preferred and convertible markets evolving for MSTR? Are you pivoting away from convertible notes going forward and really going full in on the preferreds, or will you continue to do both here and there?
I think we'll focus on preferreds. I think that preferreds are a much better source of leverage, and they attract more long-term capital, and they're more scalable. So I think I think that for a Bitcoin treasury company, if I was creating a Bitcoin treasury company from scratch, or I'm advising a Bitcoin treasury company, my advice is skip bank debt, skip securitized borrowing, don't borrow against your Bitcoin, skip senior debt, skip junk bonds, skip the convertible bonds. If someone, I would go direct to the preferred market. I would issue a convertible preferred stock first, then a senior fixed income preferred stock second, then a junior fixed preferred third. And there are other things you could do, and we're exploring some of the other ideas, but what I just described is Strike, Strife, and Stride. It's right in front of you. You could just copy them. They're the three most successful preferreds in the century. Why wouldn't you just copy them? If you're a Bitcoin treasury company, you ought to be thinking, if I issue a preferred that's got a BTC rating of 10, it's investment grade. If I have $1 billion of Bitcoin, I can issue $100 million of that. If I issue a convertible preferred with a BTC rating of 5, it's pretty high quality. You know, maybe it's just one notch below investment grade. And if I am going to a BTC rating at 3, it's more like high yield or junk, or BTC rating at 2. It's like junk grade. And you have the option to issue things at any level there you want. When you do it, put an ATM on it, right? File a shelf registration, and then you're in the business of generating yield and generating BTC gain by issuing credit instruments in the capital markets, and your competitor is low quality bank preferreds, junk bonds, private credit, mortgage-backed securities, investment grade bonds, money markets, all of these things, corporate paper, right? Whatever it is, except your advantage is you can pay a higher yield and you can offer more collateralization. But at the end of the day, the winners in this market are people that have conviction and capital, and they're willing to look out a decade. And that's the advantage of the Bitcoin maximalists, right? Like we can go harder than anybody else. We can outlast anybody else. If you look at my best speech, by the way,
yeah,
I think my best speech is at the Atlas Society. If you go and you pull it, and if you look at me, I'm quite confident and comfortable and articulate, and didn't have any concerns whatsoever. I think Bitcoin that night had crashed from 66,000 down to 19,000, and it was trading below 20,000. And I had friends in the audience said, yeah, you were so persuasive. I went and I bought Bitcoin that day. I felt like I didn't have enough. Well, we were buying it at 19,000, 18, 17, and 16,000. I was just as convicted then as I am now. I didn't feel any different, right? The shorts, they can't handle that, right? Their brains don't work that way, right? I mean, they're not acting from fundamentals or first principles. My view is just, well, it's pretty obvious Bitcoin's oversold due to the crypto leverage coming out of the system. That makes it less risky and a better buy today than it was at 50,000. Why wouldn't you buy more?